Hi everyone, thanks for joining us for this second webinar in the small business series that we're doing this week. Our aim is to keep the presentation within 45 minutes, and then if you want to ask some questions, we'll stay around for a bit longer and answer them. However, please feel free at any time to ask a question in the Q&A box below, as my colleague Bevan is standing by to answer these during the webinar. We're also going to send you a link to the recording of this presentation, and we will also send you the slides in the next few days, so don't worry about having to write every single thing down. Okay, so who are we? We're an accounting firm on the beautiful Sunshine Coast in Queensland, and we specialise in clients with small businesses and also in property developments and property investors. I've been an accountant for 20 years in November this year, and my colleague Bevan has a few more years experience than me, but that doesn't mean that I'm ever going to admit that he is wiser. So our client base is not just Sunshine Coast based, it's spread all over Australia and also worldwide, which we can achieve through the use of technology such as online meetings and file sharing. Of course, we also have a lot of local clients, and we're happy to have clients come into our office and visit us, or we're happy to also go and visit our clients. We also offer before hours and after hour appointments, because we understand as business owners, you can't always just get in somewhere 9 to 5. We're a real big believer in having fixed fees for our clients, and these are tailor-made to suit each client. There's no such thing as one size fits all. These fixed fees can include proactive services such as tax planning and business improvement, along with the standard bookkeeping, BAS, year-end financials and tax. If we're able to help you, or if you want to chat further about anything in today's webinar, please don't hesitate to contact us. So my objective for today is to give you an overview of the 3 main financial reports that are commonly used, and to explain what they portray and also what their limitations are. I'd really love for you to leave this webinar with a deeper understanding of your financials, and even better, to take this knowledge and use it when planning and preparing budgets for your business, which just happens to be the next webinar in our series tomorrow. We do need to state up front that this is not specific advice, rather it's general information directed at small business owners. And according to the ATO, a small business is anything less than a $10 million turnover. Given the time constraints, there's only so much we can cover, and I apologise if I skim over an area of interest to you. Again, please ask questions below, or we'll try our best to answer them at the end, or if we can't do that, then please contact us. Okay, why bother? I congratulate you even on coming this far, because many business owners think that financial statements are something they just need to get prepared by the accountant for tax, and they don't really want to understand what they represent. And some of the other reasons we hear are things like, they're so boring. Okay, that may be partly true. I already understand my business. These financials really don't make sense and reflect what I think is happening in my business. And that's what my accountant's for. There are, however, benefits to be had in understanding your business reports, including if you want to get a loan from a bank, it helps to know what they're looking for and they're looking at. If you want to sell your business, then most potential buyers want to see 3 years worth of financial statements, and to get the best price for your business, your financial statements need to tick all of their boxes. These are also the figures your accountant is going to use to work out how much tax you have to pay. And in addition, you may have some other legal obligations you need to meet by providing these reports to a third party. For example, if you have existing finance, or if you're lucky enough to be a builder in Queensland and falling under the watch of the QBCC and the new reporting regime. But most importantly, understanding financials is the gold standard of business practice. And as I mentioned before, you can't efficiently monitor, budget, or plan for your business without understanding the reports used to measure this performance. So even though financial statements reflect a backwards look at what the business has done, if you're monitoring these closely, for example monthly, you will pick up any potential problems early on. Okay, so that's probably enough general babbling on my behalf. I just want to do a quick poll to see what everyone's currently using in the way of accounting software or record keeping. just launch this poll. If you could let me know what you're currently using, that would be great. Okay, most people have answered. And the winner by far appears to be Xero. So 40% of people are currently using Xero, 17% are using MyOb, 6% are using QuickBooks, 11% are using other accounting software. I'd love you to pop in the chat box what that is. There's always new ones coming out and we're always interested to see what people are actually using. 17% are using Excel spreadsheets and 11% said not relevant or undecided. We're very big on MyOb. You know, all of our accounting software runs on Xero. All of our accounting is run on Xero. We have a lot of the Xero add-ons. We use it for our own practice. We really love it, but we recognise that it does have some significant, I guess, limitations, especially when it comes to stock and that sort of thing. What I will say is, regardless of what system you're using, and this is especially for people who are using accounting software, that often what accountants will do is we'll take your figures, say from MyOb, and we'll input them into our Xero. And so what that means is your MyOb never equals what your accountant figures are. What I would suggest you do next time you get your year-end financials prepared is ask your accountant for a reconciling journal. So it's an entry they can put into MyOb, so your figures in MyOb then reflect the figures that they've done, or even better, if they can just prepare your figures in your software. Those people using Xero spreadsheets, I have absolutely no issue with that. And I must say, people who use Xero spreadsheets and use them well, often it can be done better than using accounting software if you don't really understand it. So there's really no right or wrong answer with that one. Okay. I'll share those results if people want to have a look. Okay, so the reports we covered today are going to be the profit and loss, which is, and I need you to insert air quotation marks here, a summary of all the income and expenses for the year. I love the way that makes it sound so simple and easy, but in reality it's not, and this is the report I'm going to spend most time on today. The balance sheet shows the assets and liabilities, and this in turn helps you to monitor the financial health of your business. And finally, we will have a look at the cash flow statement. It's not as well known as the other two, which is a pity because it's usually the report that makes the most sense to business owners. This one really does simply show you the actual money received and spent by the business from and to all sources. When looking at financial statements, it's important to know that the preparation of these is governed by the Australian accounting standards, which all accountants must adhere to. And this, of course, takes into account how the tax legislation treats various items. The positive of this is that all financial preparation use these standards, and so there's uniformity, and the information I share today will apply to all small business owners. The disadvantage is that the way we treat some things may not make much sense, and there's not a lot of scope for us to change it. So in order to look at some financials today, I'm going to continue with the case study that Bevan introduced in his webinar yesterday on business structures. We're going to be looking at Jenny's Chocolates. She's operating through a company structure. Initially, she put in $200,000 cash to start up the business. She used 165 of this to purchase equipment, and she purchased a new car via a loan in May 2018. The trading history was she started in April 2018, and she pays herself a wage due to this being a company structure. So here's the profit and loss for Jenny's Chocolate. And I can tell you the first thing the majority of my clients are going to say when they look at that is $32,000 in profit. Where exactly is that? Because I can tell you I don't have it in the bank. And in the vast majority of time, my clients are right. But this figure is really important because if this is the figure your accountant is using to complete the company tax return, this would result in a tax bill of around $8,870. The company tax rate is currently 27.5%. So the profit and loss, or where is my money? So firstly, these figures are exclusive of GST. So if you have a sale for $1,100, it will show up as $1,000 in the profit and loss. This is because that $100 of GST isn't your money, it's the government's, so you don't have to pay tax on it, which is great. But of course, this is the same principle for expenses that also have GST. Secondly, most financials are prepared on what's called an accruals basis. But when it comes to tax, you can report on either a cash or accruals basis. The cash basis is pretty self-explanatory, and it's what most people think the financials reflect or should reflect. It mostly just shows the income and expenses that have been actually paid and received into your bank account throughout the year. The accruals basis, however, takes into account things like debtors, which are amounts for sales that are owed to you but haven't been paid yet, and creditors, which are amounts you owe, for example, stock or advertising, that you haven't yet paid. So for example, here's Jenny's Chocolates aged receivables. So this shows her debtors, and you will see that she's currently owed about $36,000. This amount actually includes GST because her customers owe her that money, and they owe her the money including GST. But then if we move back to the profit and loss, that $36,000 excluding GST will be up here in her sales figure of $154,000. So let's have a look at what effect that actually makes on her bottom line and on her tax. So if she's reporting on the accruals basis, the profit is $32,000, and at the 27.5 rate, it's the $8,870 I just mentioned. However, if she now reports instead on a cash basis, the profit's still the same, but you add back the debtors, excluding the GST, and we're also assuming that she has about $6,800 in creditors for advertising and legal bills, so we also have to adjust for that. So once we've adjusted for debtors, the business is actually at a loss of $476. After we adjust for the creditors, her profit is $5,704. You can see that is a huge difference from the $32,000. And at that level, her tax on that would be $1,569. So as you can see, it's important to understand and make an informed choice on which basis to use rather than just relying on the figures in your financials. The good news is, as a small business, you get to choose whether to report to the ATO on a cash or accruals basis. Any business that's not a small business has no choice and has to report on an accruals basis. Okay, so we've covered the top two. Now, it's not always going to be better to use the cash basis because it is going to depend on your business. So for example, if you don't issue accounts and everybody just pays as they get your product or service, then you're not going to have any debtors and your sales will be the same regardless of whether you're cash or accruals. However, if you also then have expenses that you pay on account, you should use the accruals basis because you get the tax benefit of those expenses that you owe at 30th of June, even though you haven't paid for them yet. Regardless of what method you choose for tax, I do suggest you use the accruals method and include debtors and creditors in your financials, as I believe it gives you a clearer picture of what the business has actually done during the year. So that was definitely the heaviest part of my presentation today, and I'm glad you've all managed to hang in there with me. I do promise it gets easier from this point on. The third factor that affects the profit and loss is depreciation. So depreciation is when you buy an asset that will be used in the business in the long term, which basically means over 12 months. Now, at the moment, any assets that cost less than $30,000 can be claimed in full as an expense. This amount's been chopped and changed throughout the year, and I've listed those different amounts. But basically, the $30,000 is here to stay until June 2020. However, any amount that's over that $30,000 can't be claimed immediately, and we have to claim it over a number of years. So each year the ATO publishes a list of all assets they can think of and how many years you must claim that asset over. My personal favourite, which sadly is now dropped off the list, will always be the stuffed crocodile, which apparently only lasts for 20 years. More mundane things like a motor vehicle will last for 8 years, computers last for 4, but mobile phones and laptops only last for 2. There's a couple of different methods for calculating depreciation, but I'm not going to cover those in detail today. So let's look at how this has affected Jenny's P&L. You'll see down here that she has a depreciation of $29,000, close to $30,000 for the year. And this is because she spent that $165,000 in equipment in the previous year, and also because she got a motor vehicle on loan in the previous year. So she gets to claim this $30,000 in her tax return, and obviously it appears in the financials, but she hasn't actually outlaid that $30,000. Her outlays were in the previous year. So the fourth item that may be reflected differently in the profit and loss than the actual cash outflow is if you have a loan, hire purchase, chattel mortgage or a lease. The type of borrowing you have will determine how it's treated for accounting purposes. For example, a lease is just nice and simple. You claim the full payment and it shows up as an expense. Anything else, such as a loan, hire purchase or chattel mortgage, are all treated completely different. These types of equipment finance mean, from a technical legal viewpoint, that you immediately own that asset, and therefore you claim the depreciation on that asset and the interest portion only of the payment. This is the same principle if you've got a business loan, say for cash flow purposes. You don't get to claim the full payment, you just get to claim the interest on that loan. So once again, let's have a look. How does this play out for Jenny's chocolates? So Jenny has this motor vehicle loan and she's paying $645 per month. So because we're looking at these financials at the end of May, it's been 11 months. So in total, she's paid $7,095, but on the financials, in this depreciation, she's claimed $9,995 for the motor vehicle and interest expense of $2,345. So all up, she's claimed $12,340 for that hire purchase for the motor vehicle, even though she's only actually spent $7,095 for the year. So even though over the life of the asset, you will get the same deduction, regardless of whether it's a lease or other types of finance, other types of finance will give you a higher deduction in the first couple of years. And this is something to consider, and especially when you're looking at things like tax planning. So finally, the last item that we're going to look at on the profit and loss is stock. So we're starting to head towards the end of June, and all of those stock take sales ads are about to start. Try as I can to control myself, much to my family's amusement. Every year, I get really annoyed at the ads, specifically that say, we're selling because our accountant told us to. The reason it really annoys me is because it's actually the last thing your accountant wants you to do, to have a massive sale in June and ruin all of that tax planning work we did back for you in April and May. If you've bought a widget for 50 cents and you sell it for $1.50, in June you've now made $1 in profit, and we have no way of tax planning for that. Now, obviously that's a very selfish view from an accountant, and of course, please don't think that that doesn't mean you should go right ahead and take advantage of that consumer hype and have a sale and make some money. Just don't say in your ad that we told you to do it. Each year you will have purchases of stock. As you can see here, Jenny has $42,000. However, at the end of June, even though she's spent $42,000, she may not have sold everything. So this $42,000 doesn't really reflect the cost of the products you use to generate those sales for the year. And the ATO certainly doesn't want to give you a full deduction for that $42,000. This is why stock values come into it. By calculating how much stock you have at the end of the year, you get a figure that reflects the true value of stock associated with the sales for that year. So when we're looking at Jenny's figures, she started with 28,000 stock. She spent another 42,000, but at the end of the year, she still had about 45,500 in stock. So this means the actual stock that she used during the year was 24,400. And this is what generated her sales of 154. If we just ignored all of this and we just used the 42,000, this really doesn't allow us to compare periods or years to see how the business has performed. Importantly, the ATO has benchmarks for a lot of industries, and you can see how your business performs compared to others. A client told me when they started looking at these figures, they saw that there'd been a really large dip for the last 9 months. And when they further discovered or looked into it, they discovered that one of their staff had actually stolen $175,000 worth of stock in the preceding 9 months. So, you know, there are practical real world reasons that you need to be looking at these figures and understand what they are. Now, if you're a service business, then most likely you're not going to have any stock, but you might have things like work in progress or WIP that acts in a very similar way. So this might be something like a builder who's partway through a building of a house. You really do want to make these adjustments and have a look how that affects you from a tax point of view. Now, this stock figure is usually the value you purchase the stock for, but it doesn't have to be that. You do have a choice of reporting it at cost, market, or replacement value. This might be important because if you bought 1,000 widgets at $1.50, but they're now only worth 50 cents, you will want to make a stock adjustment, because the higher your closing stock figure is, the higher your profit will be. So you want to make sure it's correct. Which then leads me on to stock takes. Now, as a small business, if your stock value has changed less than $5,000 between opening stock and closing stock, you aren't required to do a stock take, which is awesome. But it also leads me to think, well, how do you know if you don't have to do a stock take? The ATO has said that basically you must take into account all relevant factors and considerations, have a rational process you can explain, and be conducted on a good faith basis. Okay, so that's the end of exploring that really simple profit and loss statement. So to quickly recap the following areas, we looked at the fact that the figures are GST exclusive, that financials are usually reported or should be reported on an accruals basis, but you may be better off reporting to the ATO on a cash basis. We covered depreciation and the different accounting treatment of loans, finances, leases, and we concluded with a short discussion about stock. So let's move on to the balance sheet. Thankfully, the balance sheet is nowhere near as complicated as the profit and loss. It comprises of 3 areas: assets, liabilities, and equity. So an asset is anything that the business owns or is of value to the business. For example, bank accounts, debtors, and money owed to the business. Assets are then further broken up into a current, non-current assets. A current asset is anything that can be converted to cash within 12 months, for example, stock or debtors. A non-current asset is something that can't be converted within 12 months. So it might be a motor vehicle, plant and equipment. A liability is anything that the business owes to someone else. For example, credit cards, bank loans, ATO debts. These are also broken down into current and non-current assets. Equity is really just basically the difference between assets and liabilities, and it's reflected as a figure called net assets on a balance sheet. So why is this thing called a balance sheet? Let me show you an example. For the science nerds in the room, the balance sheet basically operates like Newton's third law of physics. For every action, there's an equal and opposite reaction. And don't worry if this is a bit of a hard concept to wrap your head around, because this is the bane of every accounting student's life. If we take, for example, money coming in from a customer, your bank account is going to increase in value. And then that will then in turn increase your profit and loss, which increases this figure here for retained earnings. If you pay a debt to the ATO, your bank account's going to go down, but the liability to the ATO is also going to go down. These movements that affect the balance sheet change the overall net position of the company and in effect will change this line, which is the net assets. These movements up and down is why it's actually really hard to try and hide or adjust figures, make them look better than they are. And that's why banks and prospective buyers want to look at your balance sheet. Specifically, they and you should be looking at these net assets to see that they at least stay the same or increase if your business is in a growth phase. Let's explain some other items on the balance sheet. We might start with the motor vehicle. So as we previously discussed, Jenny purchased a motor vehicle via a hire purchase. The purchase of the car is here and the loan that she took out is down here. So the loan is actually grossed up to include the interest that she will pay over the life of it. So the net figure of it basically comes down to what she paid for the motor vehicle. When we talked about depreciation before, you will see that there's this account called accumulated depreciation, and it increases each year with the amount of depreciation she's claimed. You can see that the actual purchase price of the motor vehicle never changes. Now, the difference between these two figures is what you'll often hear accountants refer to as their written down value or book cost, basically, or book value, sorry. This figure is important as it represents the value of the asset if it's sold. So for Jenny, this motor vehicle is now worth about $34,000. She gets an offer tomorrow to buy this car for $50,000. She's then going to have a $16,000 profit on it, and she's going to have to report that as income. Well, the company will have to report it as income and pay tax on it. So this is the way all of those major assets, motor vehicles, plant and equipment, are recorded. And obviously the purchase price of these are excluding GST because the GST has been claimed back on them. Things like the closing stock that we talked about is also reflected. Here's the debtors figure we talked about, and also the accounts payable or the creditors figure that we discussed. Now, there's also ATO payments, so GST, pay as you go, and any super she owes for staff members. Depending on the structure your business uses, you will have some accounts that relate to money pulled out or put into the business. In the case of a company, this is called a director's loan, and you'll see that there's two. There's director's loan from 2018 and a director's loan for 2019. So these are the amounts the director has either lent to the business or amounts they have taken out of the business. In the case of a company, if you withdraw money or you use company money to pay for personal items, then it becomes a loan from the company to that director, and it has to be repaid within 7 years or have a dividend declared, and also needs to have interest calculated on that loan every single year. Sole traders will normally have accounts called owner's drawings and owner's contributions, but there's no repayment requirement like a company has. A trust will normally have beneficiary loan accounts, and again, these reflect the amount that the beneficiaries have contributed or withdrawn from the business, but they also reflect the amounts that they have received as a trust distribution. Now, I could probably spend another few hours on this, but I'll very generally, trusts don't pay tax. So it must choose an individual or a company to distribute its profit to, and then that individual or company pays tax on that profit. So the ATO might not actually require these loan accounts in a trust to be paid. They certainly come under scrutiny in things like family law matters, or if there is a dispute between beneficiaries whether they actually received that amount of money. And once again, I'm sorry to really cover that one quickly, but it can get quite detailed and in depth. So let's move on to the last report, which is cash flow statements. And this one is generally unheard of, but it really shouldn't be, because if cash flow is king, then the cash flow report is the ruler of all reports. This is the one that business owners look at and think, aha, that's exactly where my money went, and I can see that it's come in, I can see everything I've spent it on, and there's none of that sort of accounting trickery of treating things differently. This is a great report for looking where your cash has gone, but this is not a report to look at if you're trying to work out what your tax position or what your accounting profit and loss is going to be for the year. So let's have a look at one for Jenny's Chocolates. So when you first look at it, it looks very, very much like a profit and loss. But as we scroll down, you can see it includes a lot more. In Xero, they actually call this one cash summary, but MYOB and Xero definitely refer to them more as a cash flow statement. You can have these including GST as well. So instead of just having your sales reported as excluding figure, you can actually have them including. So you will see, the profit and loss said 154, but year to date it's actually saying a completely different figure because that's what's being received into the bank account. A lot of these expenses are going to be the same, but you'll see in here, actually you won't see in here, things like the depreciation, because they're just not there. Depreciation isn't something you've physically paid. You also won't see the interest on the motor vehicle because it's not, while the interest has been paid via the loan payments, it will then be included in this loan payment for motor vehicle, not just that accounting function of the interest only portion. So moving down, you'll see that a lot of these are the same as the profit and loss, but they're just straight up expenses that have come out of the bank account. So it's saying basically if we look at year to date, that there's been movement into the account of 7,265. Now that was kind of the operating expenses. If we look at the non-operating things like director's loan, it shows us, money coming in and out of that director's loan. It shows us payments to the ATO. It shows payments of super and payments for the motor vehicle. So all up, it's showing for the year that there was actually cash coming in of 59,727. This figure here is the opening bank balance at the beginning, plus this movement of cash has a closing balance of 77,261. And that's actually the figure that equals the bank accounts on the balance sheet. So this one's a really good snapshot of what did I spend that money on. The profit and loss is saying, well, I had $36,000. This is actually saying she had more than that, but part of that is money she's contributed as well to the business. So this is a really good one to try and get your head around and understand what's come into the business, what you were spending on, and especially with that whole planning and budgeting. Now, if you're only budgeting around your profit and loss, then you're not taking into account things like loan payments, which are, a huge expense for many businesses. Well, that's the end of the presentation today, and I actually ran a bit faster than I thought I was going to. I really thank you for attending, and I hope I've managed to shed some light on these reports, and especially how and why they should be used by you. Now, if I was to give you homework, it would be to go and have a look at your financials and consider what now makes sense, and does that provide any opportunities for tax or more accurate reporting? And also, what don't you still understand, and what do you need further help from your accountant, or we're happy to help you as well. I'd also say to you, set up a reporting schedule. At the very least, and I cringe when I say it, you should be looking at these reports every 3 months, but really you need to be looking at it monthly because you will see problems. If you're looking at that cash flow, you will notice straight away, if you've got more cash going out of your bank than coming in, you will need to do something about it. Once again, thank you for attending. I'm actually going to stop recording it now and happy to take some questions via the Q&A box.